everybody, and welcome to the Eitel Insights podcast. My name is Dane Eitel, and I am the founder and lead analyst for Eitel Insights. Today we're going to be dealing with the Greater Vancouver condo market. We're going to be updating the charts and the data as the new data has just come out. We're actually going to be dealing with a few of the comments and questions over the past few podcasts as well. And of course, we're going to deal with the ramifications of our new reality living this coronavirus issue and how that's going to impact our economy already and how it will continue to. And then, of course, how that impact will reflect in the real estate market. Before we get too far, if you do like our content, if you appreciate the podcast, we ask that you give us a like, subscribe to the channel, and of course, leave your comments if you like it, or your questions, or even if you're adversarial. We'll try to deal with those in a friendly manner as we will here today as well. So as we said, we are going to get to some of the comments. Firstly, I'd like to deal with one of the issues where, people say that the market in Vancouver is basically immune to a correction. That's a complete fallacy. If you check the history of Greater Vancouver, we have experienced markets where they corrected 30+%. Now, of course, that was an extraordinary time when interest rates were at all-time highs. But to say that we're not living in an extraordinary time now, in my opinion, is a fallacy as well. So let's just deal with some living examples of markets that have corrected 30%, and those are the major stock markets in North America. So the Dow Jones Industrial Average, it came from 29,500 at the peak down to 18,275, which is a 38% correction. Now, that was about a week ago. 18,275 is a very strong technical indicator. To me, it was no surprise that the market bounced after reaching such a price. Currently, the market is at 21,000, which signals a total correction of 28%. So again, living examples of markets correcting the 30% plateau. And then, of course, we got the TSX peaking right around 18,000 to going below 12,000, which was a correction of 33%. Currently, now it's back above 13,000, which leaves you at a 27% correction. So, I really, of course, everyone that has followed us, we believe the market is going down the total correction in the Greater Vancouver condo market 30%, from 751,000, which was achieved in January of 2018, to likely in 2021 prices seeing 525,000. And again, maybe a month ago or 2 months ago, it was harder to believe. And given our new reality, it's a little bit easier for folks to believe. And that's why we love technical indicators. It doesn't know the name of an issue. However, there was enough analytics for us to say, hey, there's an opportunity that we don't want to be a part of on the purchasing side. And if we had a number of properties, we were trying to unload them. And that leads me to my next kind of comment that seemed to be a bit contentious by the way it was written. However, yet again, he was this fella in particular was a living example of what we've prescribed sellers do here over the past quarter or quarter and a half. And that was to list your property. Basically, the comment kind of went, that there's not enough sales, and that's simply just due to the erosion of inventory, and the market would rebound. And that's fine and fair, and he was on the selling side of this. He had a multiple offers, very busy open house, and he sold the property. And we're going, congratulations, that's exactly what we advise people do, is to list into this pocket of strength. Not one time did we advise to purchase in this market, and we're very grateful. Unlike a majority of the other analysts out there who did say 2019 was the bottom. You got to start buying the market. If you don't purchase, you'll miss out on it, this and that, for about 6 months. And now we're past the first quarter of 2020, and they're flopping like fish. I mean, now the market's going lower and this and that. And, if you took their advice, you're almost paying for it now. If you took our advice, you were in a similar situation that the comment was. If you listed at a realistic price, you got a lot of activity at your opens, and you achieved the sale. So much, it was so good, in fact, that we'll just toss the chart up here right now, that you got the highest sale price since October of 2018. The average sale price came in at $699,000 in March, which again is the highest since October of 2018. This did resolve the divergent trend that our followers know we've been talking about. And you did need an explosion one way or the other. Honestly, unfortunately, for those that had listened to other analysts, you just paid the near-term highest price over the past couple of years. Our advice was to sell to them. So Eitel Insights clients sold to other analyst clients, and we're very happy with that trade. Our clients just got the highest price in the past couple of years, and their clients just paid the highest price. Eitel Insights does offer actionable intelligence. Not once have we suggested purchasing. We have suggested selling into this pocket of strength before it blows up. Lo and behold, this is currently in the midst of blowing up. So, if you have listened, you've done very well on the sell side. You're saving your powder for a better opportunity to purchase down the road. And that will happen. I'd like to deal with another misconception right now where, everybody thinks that we're just perpetually negative. And yes and no to that kind of sentiment. The market, in our opinion, is very much going lower. This is proving our case that the issues, the economic woes, and the coronavirus pandemic. Technical analysis didn't know what it was going to be called. However, it did say there's something here that we don't want to be a part of as an equity owner. So the markets will continue to correct, and taking or heeding our advice, you will do very, very well. Ultimately, this market will have an opportunity to purchase. We're not there yet. There will be a day when Eitel Insights says, hey, you know what, there's a time to purchase, and we can start going in 2 feet full bore. And just on that, there is an interesting kind of even dichotomy with that. There's a difference between an owner-occupied place and an investment. The owner-occupied places, we will give you the green light to purchase quicker than the investor. The owner-occupied, it doesn't really matter maybe the last 5% or so, as long as the market starts to show itself as a bottom and that there's an inevitable room for it to go higher. As the investor, we want to be darn sure that this market's not going in lower, an additional 5% on top of that 5% that maybe we're unsure of. So you really need that data to kind of prove itself a little bit further than the owner-occupied properties. This being said, where we are right now, as we said, we'll update these charts as we go forward throughout the past podcasts. One of the interesting things, though, again, to compare Eitel Insights to other analysts, even if you look at our first publication, our very first publication in Western Investor, I believe it was 2017, where we were featured, we said the market would be in a prolonged cycle and it wouldn't bottom until 2021. We've never waffled off that. We don't flip-flop like the other analysts and say, hey, it's time to buy, it's time to sell, it's time to buy, it's time to sell. If you've listened to all the flip-flopping, you've lost a copious amount of money. With us, you've sold at the peak and you're riding this market down. If you didn't sell at the peak, we've alerted you to opportunities to sell where there was pockets of strength. So that kind of deals with some of the comments. One of the other interesting comments that I'll share with you now, and I couldn't really share with the public before, it was a very interesting comment. I really liked it, and it basically said, because of the real estate market, are you anticipating a real estate driven economic recession? Really like the question. Unfortunately, you kind of have to be an Eitel Insights client to get such actionable intelligence, right? That's a very specific question. And now that we're seeing some of the realities, I can kind of illuminate you as to what I've told my private clients. Yes and no. It's all kind of part and parcel in Greater Vancouver, right? Greater Vancouver is your metropolis city, such as the Toronto, such as the New Yorks, the coastal cities in America. And they run hard and they fall hard. What's interesting about this kind of place and time where Greater Vancouver's at and the world's at, everything was fairly lofty. Greater Vancouver's real estate prices were kind of already were definitely falling off, to the 20% stress test mitigation level, which is why you saw purchasing last year. It wasn't the market bottom; it was stress test mitigation, as we advised you all along. And now you're seeing the economic realities of that, where the market, it tried to go higher, but it can't because there's nothing sustaining it. Same with the stock market. At 26, I was at 26.8, I wasn't a believer. At 29.5, I certainly wasn't a believer. There was no rationale for it to go that high, that fast, or anymore. So everything kind of needed to come back. Was it real estate? Was it the car sales? It was kind of an everything bubble. It was an economic bubble. The businesses were paying way too high in their rents. If they closed their door for a weekend, they couldn't pay their monthly rent. Now they're closing their doors for 2, 3 months, 4 months, who knows how long. this economic reality will be a bloodshed. And it's something we've been forecasting would come. We said chaos in the streets. We said blood in the streets. It's not going to be a pretty time. Contrary to go out and buy now. It's the bottom. And now, well, it's not the bottom. So again, Eitel Insights offers you actionable intelligence and on a broad basis, and for our private clients, even more so. So if you want to get in touch and be a private client, visit eitelinsights.com. No worries, we got a plethora of options, and coming forward, we'll actually have even more. So I kind of took a little bit of time dealing with that. We'll run through some of this other data. It is interesting, but it's nowhere near as crucial as the price chart and kind of the overall environment we find ourselves in and how we see it going forward. Now, dealing with the sales, I'll just toss that up on your screen. What's interesting about the sales, and I believe I said it in a podcast, a few months ago, and I'll reiterate it here again. The difference between the sales data and the pricing data, sales data is a data point when you have a sale at land titles. Basically, when you exchange the key is when the real estate boards counts that as a sale. When they add up the average sale price, they're using accepted offers. So it's not actually a confirmed or a done deal. In essence, it's a firm and binding deal, and you have a legal contract, but it's not done. The sales are completely done. So for the done deals, the key exchanges in the month of March, there was just below 1,184 sales. So, we're kind of dealing with dated history or in this data point, in the sales data point. So for the next couple of months, you could even see some nominal sales, but then going forward, we'll see them fall off again, simply due to supply demand, right? You're going to see a lot more inventory show up, and the sales will stay nominal, but there's so much inventory. Why would you go into a rush to purchase when you know you're going to get something at a cheaper price by waiting? It might not be that exact product, but it will be a similar type product, right? A condo is a condo at the end of the day. So now let's deal with the inventory. Inventory basically did bump up a little bit, but it wasn't to any nominal or extraordinary levels. That's still absolutely coming. I mean, with all this money being lost, there's going to be inventory showing up on the market, no doubt. So again, to our advice, you should have beaten the crowd. Now the crowd's coming. So over the last quarter, if you had lists, you had a good chance to sell, just simply due to the lack of competition and some buyers being willing to buy, maybe heeding other people's advice. God bless them, no worries. But results are results. So going forward, we're going to see a lot more inventory. Prices will inevitably come down due to that, just because of the supply demand. And also, we're actually starting to see the realization of the completion from the pre-sale market during 2016 and 17. So there's a couple of buildings. I'm not going to throw anybody under the bus particularly, but just do a Google search and you'll find the brand new buildings, copious amounts of listings, both in rentals and in the sales department. So there's properties available, and this will actually come to a finalization of what we said something about a year ago on Linda Steele's show, which is basically this condo market will be a self-cannibalization. And by that we meant the older buildings will actually have to go so low in price to achieve a sale, especially given this new insurance reality, which won't be long lasting, but is in place right now, where the new properties have a 10-year warranty, 10-year warranty. The older ones have nothing, and you're worried about insurance payments. If there's a leak, you're in all kinds of hot water. So you're just going to stay away from those. Those owners will have to decrease their price to such a degree to get anybody interested in purchasing that property. Once prices on the resale market go so low, then the new properties will have to kind of follow suit and go down as well. It's a cannibalization factor. Something we said a year ago would happen, lo and behold, is coming to fruition now. It's something we're getting fairly used to, and so are our clients, and something that maybe seems a little bit outlandish at the time, absolutely comes to fruition in not the too distant future. Just before we leave you here, I will actually go through the days on market, which will reiterate again how you did have an opportunity to sell in a timely fashion, and as we explained earlier, achieve the highest price in the past 2 years. The average days on market for the sales for the properties that actually sold were only 29, which is the lowest that we've been since basically 2018 again, which is no coincidence, which is why the prices are there. And that's after a couple of months since January, where the average days on market was at 43. So again, by taking our clients, taking advantage of other analyst clients, we've done very well. Literally, our clients sold to other analyst clients. Their client were happy. Our clients are happy. Now their clients are maybe not so happy, and our clients are still very happy. So that being said, I would like to point out, we talked here about some of the detractors and maybe some contentious people out there. What's interesting in our mentors and the people that actually continue to promote us and appreciate our work, it wasn't to be maybe the most fan-friendly or any of that. It was to be correct. That was our mission. That's our modus operandi, is to absolutely be correct, to offer actionable intelligence to our clients, to the public. And that's what we're doing. We don't waffle. We don't waver. We are correct. We use different metrics than a whole host of everybody. We're the only ones using technical analysis in real estate markets. We judge the market psychology and where they want to go, where they are going. We've been correct. We'll continue to be correct. We appreciate you for listening. Again, if you liked it, give us a subscribe, give us a like, leave a comment for a future podcast. And just on that, again, we will be releasing some national data this month, and of course the detached market update as well. Everybody stay safe, stay away from each other unless you're friends or family.